All right. Today's Sunday, the 16th of March. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. I hope everybody had a great weekend. It is a beautiful evening here in the city of Las Vegas, Nevada, USA, where we got some rain over the weekend finally. Yet the weather is changing from winter to spring. It is really beautiful out there. We got some snow in the mountains, and the weather is beautiful. Your boy took advantage of that and went hiking at the Red Rock Canyon over the weekend. And look at this. It looks like a friggin' painting. A lot of you who visit Las Vegas, you stay in the Strip, and you never really come out here. But you gotta check it out next time you're in the city, because it is beautiful. Not in the summer, though. You gotta come over when the weather is nice. You change the scenery from the casinos and the Strip and all of that. Enjoy a little bit of nature. You know what else is making me happy this time of the year? It is gardening season, baby. A lot of the plants that were dormant, because we got a little bit of a brutal winter here in Vegas. It was really cold. But now the weather is getting nice. As we say, hello, spring. A lot of the plants are coming back to life. The raspberries are coming back to life. The grapes are coming back to life. The blueberries coming back to life. The citrus, the lemons. Looks like a promising year. See, I learned a thing or two gardening here in Vegas, which a lot of folks said, oh, you can't do it. You crazy, Maverick. You can't do that. Well, I did, bitch. I got everything last year. Tomatoes, peppers, eggplants, all kind of citrus, strawberries, all kind of berries, peaches, you name it. And the key, of course, is you got to use some shade cloth, shading techniques, and misting techniques when the summer gets really, really hot. But last year, I made eggplant parmigiana from scratch. Everything came out of the garden. Made a lot of pizzas using the peppers that I got fresh from the garden, tomato sauce. All I got to say is let the good times begin. You know where the good times are not beginning, though? It's in the stock market. I know you've been waiting for it. Because the U.S. stock market has been shitting its pants. And so far, we have wiped out $5.5 trillion out of value in the stock market. Oh, my God! Poof, gone. What happened, Maverick? I thought we got the bestest, bullishest market in history. It's a generational buying opportunity. What the hell do you know about it? Now you're beginning to face reality, but all you horses will talk about why we see such shroud in the stock market like this in a minute. But you know which stock market is doing pretty good? It's the Chinese stock market. U.S. stock market goes down and the Chinese stock market goes up. I guess we're making China great again. And speaking of vagina, ladies and gentlemen, grab your diapers, your tampons, whatever you need, because we're going to talk about a scary subject here. Without further ado, here it is. In focus tonight. Wipeout. $5.5 trillion. Poof. Gone. Goodbye. And the bad news, ladies and gentlemen, as this article says here, Steve Goldstein from MarketWatch, he says there could be a nearly $1 trillion sale in U.S. stocks, regardless of what Americans do. So we already lost $5.5 trillion, add another trillion to come. Why? Because, it doesn't matter if you buy the dip or not, because the foreigners are going to cash out. They're going to dump over $1 trillion worth of U.S. equities and migrate to another stock market that's doing pretty good, perhaps the Chinese stock market. Now, the question here, of course, is why is everybody freaking out? Because a lot of what's happening right now is psychological in nature. A lot of this is change in sentiment. A lot of this is folks freaking out. What's freaking them out? See, when Trump got elected last year, everybody thought that Trump is going to be good for the market because he loves the stock market. He's going to brag about it. He's going to do anything he can to pump the stock market higher. And if anything happens in the economy that could influence the stock market negatively, rest assured we got what we call the Trump put, meaning that he's going to rescue the market by whatever, tweeting, I guess. And this is why folks stampeded to buy the stock market hand over fist right after the elections. But now, of course, they're in the poorhouse. They lost $5.5 trillion. Of course, there's nothing lost, as I explained before. The money just changes hands. It goes from the dump. And the dump, of course, is us retail traders and investors and the mom and pops, the retirees, because you got all the pension funds, because you got the criminals in Wall Street who are managing your money. They're dumping your hard-earned cash to buy equities at insane valuations because they don't give a shit anymore. All what they care about, as the Wolf of Wall Street says, is the commission, motherfucker. Who gets richer from all of this? The banksters, the CEOs, the insiders, the oligarchy. And what's panicking people right now is there is no Trump put. In the beginning, when the market was heading down, the Trump administration was coming out and saying, yeah, this is just a pullback. Everything will be back and the market will go higher than ever before. But as equities continue to go down and down and down, they're succumbing to the reality. They're now changing the narrative to say, you know what? We don't really care about the stock market. He broke up with me, but I never really loved him to begin with. That's the mentality that they're doing right now. And when you do that, as an investor, as a trader, you look at the stock market and say, okay, if the administration doesn't give a shit about the market, then why should I? I'm going to cash out and get the hell out. But we see, of course, when everybody rushes to the exit door at the same time, we see a wipeout as big as a $5.5 trillion. And this narrative right now did not change. The administration is still saying, you know what? It is the price to pay. If stocks go down, so be it. And the most recent touch we got this Sunday from the Secretary of Treasury, Scott Bessent, a billionaire hedge fund manager. Oh yeah, that's the guy who is in charge of the country's money. What could go wrong here? It's not like Scott Bessent is just using his position to make himself richer or anything like that, right? See, folks, nothing is going to change in this country at all if we keep flip-flopping and changing from blue to red and we hire these criminals to be in charge of public positions. And their only goal is to use their power to line up their pockets. And so long as that continues to go on, this country is going to collapse. I mean, everybody's lining up their pockets. Everybody's doing their own scams. I mean, even Trump. Trump been pumping bullshit cryptos and shit coins and lined up his pockets with hundreds of millions of dollars, while the dummies who bought the shit coins, of course, are in the poorhouse right now. It would be hilarious, though, if Trump was secretly shorting Tesla, because that thing is a disaster. Oh boy. But that's a topic for another discussion. Now, you might notice if you're looking at the stock market futures, at least at the time of the recording of this video, we're actually trading down again. We got a little bit of a nice rebound Friday, and now we're trading in the red again. Why? What did Scott Bessent say? Well, he said that the White House is heading off a guaranteed financial crisis. The bank robber said that Sunday the Trump administration is focused on preventing a financial crisis that could be the result of a massive government spending over the past few years. So let's create a financial crisis to prevent a financial crisis. Oh, wow. The genius behind all of this. Anyhow, still, the U.S. debt and deficit problem worsened. Whoops. During Trump's first month in office, as the budget shortfall for February passed the $1 trillion mark. Bessent also added that there are no guarantees that there won't be a recession. Now look at this. We want to prevent a financial crisis by creating a financial crisis, and we want to reduce the budget deficit, even if that causes a recession. Well, it's not working out. They're causing the financial crisis, got it. They're causing a recession, got it. But they're failing at reducing the deficit. They're increasing the deficit. Something is not working out here. And again, this is the problem of getting Musk and Bessent and all of these oligarchs to be in charge of government. They're just going to line up their pockets and they don't give a flying fuck of what's going to happen in the country later on. At least cut the budget deficit if you're going to convey the message of, oh, you regular folks have to eat a dose of pain and your retirees have to lose in the stock market and jeopardize your retirement because at least we're closing the budget deficit, we're dealing with a debt problem. But that's not happening. And this is why folks are getting pissed off now. Bessent says that I've been in the investment business for 35 years. And I can tell you that corrections are healthy. They're normal, he said. What's not healthy is straight up that you get these euphoric markets. That's how you get a financial crisis. It would have been much healthier if someone had put the brakes on it in 06-07. We would not have had the problems in 2008. Now, I do agree with Bessent that euphoric rallies and bubbles are not healthy. But are we waking up to that fact right now? All of the pumpers, all of the puppets, all of the scumbags in financial media and in the government for the last 2 years been saying, there is no recession. We have a soft landing. Everything is okay. The economy is booming. The roaring 20s, they said. The greatest bull market in history. A generational buying opportunity at the highest valuations ever. So now we're talking about, the euphoric rallies and the bubbles are not healthy. Well, we should have taken care of that early on. We shouldn't have let the bubble inflate this big and then try to pop it. It's not going to be amicable. So again, I have mixed feelings about this. On one hand, it sounds like Bessent, at least on face value, choosing the future of the country, or choosing Main Street against Wall Street. To hell with the stock market. It's been in a bubble anyways. And if there's a recession, so be it. That's the price to pay to fix the inflation problem, to fix the deficit problem, to fix the national debt problem. Okay, I'm with that. But then the other problem is you're not really fixing the deficit problem. And it's really convenient for you to say that, yeah, healthy corrections are normal and what's not healthy is a euphoric market when you got the memo to get out before the sell-off. We covered that in details. The CEOs, the banksters, the hedge funds, the oligarchy, all of them been dumping before the sell-off. So that is one reason why we've seen a $5.5 trillion wipeout and perhaps more to come. It's the administration right now embracing a recession, embracing a stock market correction, and perhaps a bear market. Now investors are going to change their minds. We don't have protection from the government anymore. The plunge protection team got fired by Doge. The other reason is economic uncertainty. So you look at the U.S. economic policy uncertainty. It is the highest in recent months. We got a lot of polls today, and the state of the economy, according to NBC, when we asked the voters, excellent, good, only 18% say so. Fair or poor, 82% say so. So we have a souring sentiment when it comes to the economy. And that's kind of bleeding into the stock market where now even investors are saying, you know what? Maybe it is time to book profits, get the hell out, because this is not looking good at all. Let's dig down to the real reason behind what's going on, behind the economy deteriorating, and behind the stock market doing the same. We go back to the concept that we've been talking about in this channel for years now. It's called the dual risk, the duality of the risk, the inflation risk and the recession risk. What that means in a nutshell, when the Fed raised rates to tackle inflation in the year 22, and then we've seen inflation heading down, subsiding, and then the Fed paused and decided to cut rates. Everybody said that we're going to have a soft landing. The Fed engineered a miracle, not knowing that the Fed is the biggest moron of them all. And they always do the same mistake of either backing off interest rate hikes and loosening the policy too soon. And what that happens is it reignites the inflation risk. Or they keep the restrictive policy for too long that it ends up causing a recession in the economy. But the point being is there is no such thing as a soft landing. And now folks are beginning to believe that. Now, the reason behind the soft landing being a fantasy, well, it never really happened before, number one. And it didn't happen before for a reason, number two. And that reason is when you have such an inflation episode in the economy, the remedy for inflation is a recession. You have to accept a recession to reduce pricing and reverse the process of inflation. When the Fed tries to play God and they say, no, we can have an inflation episode and we can raise rates and we can drop inflation down without causing a recession. We can engineer a soft landing. This God complex by the Federal Reserve leads to a stagflation phenomenon because they cut the rates too early, they bring back the inflation risk, and now you have the inflation risk higher and you also have the recession risk higher. Why? Because the longer inflation stays in the economy, it erodes a lot of the foundations. So now you have the duality of the risk. You have higher inflation risk and higher recession risk. Thus, we have a stagflation phenomenon. And that's the worst outcome of them all. We've been talking about this in this channel, not just for 2 weeks ago or beginning of the year. We've been talking about this since the whole thing began. It's going to end up in a stagflation phenomenon. But let's examine these two risks. Let's examine the recession risk and then the inflation risk to see where we stand and why is it really souring the sentiment right now in the economy and the stock market. The headline reads, Wall Street recession odds are starting to look like a coin flip as Trump refuses to back down on his trade war. So now we have a 50% chance that the economy is going to head into a recession. And anybody who understands economics or have a little bit of experience knows that the economy has been in a recession since the year 22. The recession has been hitting the lower income and the middle income consumer. Not to mention, of course, a huge cohort of small businesses. But the reason why the economy did not officially dip into a recession, because the affluent consumer has been doing the heavy lifting in the economy and spending. Why? Because of the stock market bubble. It gives them the confidence to continue to spend in the economy. When they see their equities going higher every day, they feel wealthy and secure to use the credit cards, to spend, to take vacations, to buy homes, to buy whatever they want. And they kept the economy afloat. because we haven't seen the unemployment number rising higher. You don't see that when the equities market is trading at all-time highs. You see the unemployment rate moving higher when the equities market begins to go down. That's really important. But when we talk about the recession risk, look at small business uncertainty index. That's skyrocketing right now. And look at this. Mentions of soft landing in company conference calls is now poof, gone. They've been talking about soft landing and jerking off to it. Now their mouth is shut. They can't talk about it because it's a fantasy. It doesn't really exist. And of course, we talked about the U.S. policy uncertainty index. That is also skyrocketing. So all of this is recessionary, folks. All of this is fear and panic in the economy. Furthermore, you look at consumer sentiment. That is plummeting and dropping like a rock. That's recessionary. Why is it happening? Because not just the drop in the stock market and the uncertainty of the tariffs, but it's also the layoffs that we see all over the place right now, at least in the federal government. Thank you to Reverend Elon Musk and his Doge getting rid of thousands of employees. And the result can be seen here in the change in total household credit and debit card spending from a month earlier. You look at other regions in the country or other eastern cities, the spending actually went higher in the month of February. Jan is usually a slow month, but then we see a rebound. We have retail sales coming out Monday. That's going to be a really, really important number. But check out what happened in D.C. Credit and debit card spending is plummeting. Well, that's going to show up in the retail sales data, right? That's going to show up in a lot of the economic data as we see D.C. beginning to fall apart. The next thing, more and more cities will be impacted by the federal government layoffs. And therefore, you look at the probability of delinquency on debt. That is also moving significantly higher, closer to the financial crisis of 2008 kind of levels. Now, when we talk about the layoffs, check out this headline. For example, U.S. Postal Service will cut workforce by 10,000 after signing a deal with Elon Musk's Doge. Now, I do agree with Musk that the U.S. Postal Service should be privatized. It's been losing money year after year after year, and it's not our job to keep it afloat. And again, whether we agree on the layoffs or not, whether you think it's wasteful or not, at the end of the day, when you lay off federal employees, you're not really saving anything, at least in the short run, because you still have to pay severance, you still have to pay a lot of benefits as you lay off these employees. And now we're questioning, of course, are we laying off employees in critical positions just because Elon Musk doesn't like the specific administration or the specific government agency for political reasons, so he's just laying off everybody in it. Folks are debating that. This is why when we got the polls today, which best describes what do you think about Elon Musk Doge and their efforts to reduce spending and the size of the federal government? 33% say it should continue as much more needs to be done. Now, 28% say it is needed but should slow down to assess the impact. 33% say it is reckless and should stop now before more damage is done. And I feel conflicted. If this poll is reflecting your own sentiment about this, you're not alone. Part of me agrees with Doge in principle that we have enormous wasteful spending in the government and overtaxation, and we need to take care of that. The government has to be responsible with every penny that we pay in taxes. We need to track it down and know that we're not wasting money. We're not wasting it in foreign wars and foreign countries, in garbage initiatives and spending that don't make sense at all. At the same time, is it being politicized? Is the Reverend Elon Musk just laying off employees randomly because he feels so? That's also beginning to sink in that, wait a minute here, maybe they're just overdoing it. So I think that the rational conclusion here is it needs to slow down to assess the impact. We need to have more examination of what's going on here. Because when folks begin to hear about, oh, so-and-so lost their jobs, and another one lost their job, and another relative lost their job, you begin to feel bad about your own job security. And that impacts your spending in the economy. And if you pull back spending, that leads to a recession sooner than later. For example, you look at workers' confidence. It is dropping like a rock now because folks are afraid. Maybe I'm going to be in the chopping block next. When you look at planned job cuts to the moon, so it ain't just the federal government laying off employees, because that's going to spill over to private companies and private agencies. And we're going to see layoffs in those too. Now, when we look at initial unemployment claims for federal workers, you can see that it is skyrocketing again. So that's what's causing a lot of recession fears in the economy. And with inflation sticking for as long as it did, a lot of consumers have been using and relying on credit cards to stay afloat. Rates are not going down by meaningful percentage points on your credit card debt, and inflation is not subsiding by much. Your wages are not going higher by much. The result is we continue to see credit card loan defaults jumping. And with all of these layoffs, think about a federal worker who's been relying on credit cards to spend in the economy. They've accumulated maybe 10, 15, 20 grand worth of debt in the credit card. Now they lost their jobs. How the hell are they going to pay for the credit card debt? They're going to have to go default. And that has a recession impact in the economy. The headline reads, consumers keep bailing out the economy. Now they might be maxed out. Recession fears rekindle concerns that Americans are overstretched on debt. Let's go back to the conversation of the dual risk. Why is it that when the Federal Reserve plays the God complex and refuses to accept a recession, which is the natural remedy of inflation, and they try to engineer a soft landing, why do they end up with both risks going higher? The inflation risk, but specifically the recession risk. Shouldn't that be going down as they cut rates and ease the policy to get out of restrictive conditions from the interest rate perspective in the economy? The reason is because we have not reversed the process of inflation. Had we had a recession and deflation, we would have reversed the inflation process. So when you say that inflation went down from 6% to 3%, well, that doesn't mean shit to the consumer because they're still paying more and they have to rely on debt to keep spending in the economy. At some point, they're going to get maxed out, and that causes the recession risk to increase. So the longer you delay the recession, the painful it gets. Now, the unique aspect of this recession fear versus, let's say, last year or the year before, when the regional banks were blowing up, the pain was concentrated in the lower income consumer, but the affluent consumer kept the economy afloat. Why? Because of a higher stock market. Why? Because of a stock market bubble, the AI mania. And the Fed, of course, loosening the policy too soon. What happens if the affluent consumer begins to join the not-so-affluent consumer in their negative sentiment about spending in the economy? When that happens, the shit hits the fan. And now we got an official recession. Headline reads, the $5 trillion stock market wipeout is rattling America's big spenders. Listen to this. Americans who have propped up consumer spending are the most likely to feel the sting from the recent bout of market losses. Some are already making plans to cut back. Because when the stock market goes down, it's not the janitor who's getting hurt. It's not your gardener. It's not the barista or the postal office worker. It's the affluent consumer. The trust fund babies, the tech workers, the lazy bums staying at home trading stocks all day with grandma's money. And they feel pretty good because they scored big on cryptos, for example, and they go spending in casinos and hotels and trips and hookers and such. Well, they feel bad when their value of their shit coins go down, and they have to pare back the spending. Now, this economy has been rigged from the get-go. And when I say rigged, it is pretty much designed to serve the American dream, only to the 1%. The rest of us, we can go fuck ourselves. When you look at share of wealth in the economy, for the first time ever, the top 1% has taken over the entirety of the middle class. So when a lot of folks say, Mav, I looked at your previous videos in 22 and 23 and you were covering the macro data and it looked really recessionary and crazy, but nothing happened. How do we know that this time around it's just another scare and nothing is going to happen? Maybe you should pull your head out of your ass and listen to what we've been saying. The recession has been already here since 22. It hit the lower income consumer, the lower middle class consumer, a lot of small businesses in the economy. But because the economy is so rigged that if we have the 1% doing okay, it can keep the entirety of the economy afloat because they're the ones who are doing the majority of spending. The top 10% of earners account for half, once again, for half, all of the consumer spending in this economy. You want to have the recession, you hurt the affluent consumer. Then the whole shebang goes down. And we're already seeing the impact. We got major warnings from airliners. Delta Airlines, United, the cruises, the hotels, all of them are warning now. The consumers are not spending. They're even pulling back plans to travel. Well, gee, who's been doing all of the traveling? Once again, it's not the plumber, it's not the construction worker or the teacher. It's the affluent consumer, the trust fund babies, the spoiled brats, the Wall Streeters, the tech workers who are overpaid. They're the ones who've been doing all of the spending in the economy. They're the ones who've been doing all of the spending on airlines, for example, buying all of these first-class tickets. And the airline has been charging an arm and a leg because they can. That's how they make money. If the affluent consumer is price insensitive, charge them more. And then if the plane is not filled, who gives a shit? Because you already made the money from overcharging the affluent consumer. Well, now the affluent consumer is saying, I'm shitting my pants now because I look at my stock market account, it ain't looking pretty. So I got to stop spending. All of this is going to lead to a recession. And you got to pay attention now. Yes, it is a scare for now. I'm talking about the recession scare. Because is there a widespread recession right now? Are we seeing unemployment moving higher? Are we seeing, except at the federal level, of course, but are we seeing it in the general economy? Are we seeing unemployment skyrocketing? Are we seeing foreclosure rates skyrocketing, homes? No, we're not seeing any of that. So it is a recession scare right now. It can be reversible. But if time goes by and this sentiment, the souring sentiment sticks, it becomes a self-fulfilling prophecy. Everybody pulls back on their spending. Everybody begins to dump their stocks, and we head into a recession. A lot of folks don't understand that the majority of recessions, depressions that we got before, are a result of a change in psychology that led to a crash in the market, and that spilled over to the real economy. We could talk about that in a later video. But the question now becomes, hey Mav, if there is recession risk though, can't the Fed mitigate this recession risk by interest rate cuts? I mean, this week we got the FOMC and Mr. Powell speaking again. Couldn't he just soothe all of the market pain by cutting rates? You look at the forecast for interest rate cuts. It increased from the previous estimates in February, for example, meaning now we're expecting more cuts because recession fears are rising. Here's the problem, though. The headline reads, stock market bulls abandoned by Trump won't be saved by Jay Powell and the Fed. Why is that? Because if the Fed cuts rates this week, as an example, what is that going to convey to the economy? They're cutting rates for the wrong reasons. The Federal Reserve is afraid of something big happening in the economy that you and I are not seeing yet. That's going to scare the market even more. That's going to cause a massive flush down in the market. It's going to sour the sentiment even more. See, when the Federal Reserve cuts rates for the good reasons, quote unquote, as in, inflation went down, which they shouldn't, by the way. That's not a good reason to cut rates. But when they do it, the market loves it because they're cutting rates for the good reasons. But when the Federal Reserve cuts rates for the wrong reasons, the market takes a massive shit. And we've seen that in 2008. And this is why I think this week that the Federal Reserve and Jay Powell should not be cutting rates. They should continue to pause, wait and see what happens. And of course, that's going to cause a spat between the White House and the Federal Reserve. And Trump is going to come out and blame Jay Powell about what's going on in the market. It's going to be an interesting week, to say the least. But now that we talked about the recession risk in the economy, it's amplifying, it's increasing, it's taking over. What about the inflation risk, though? Because we got a tamer CPI than we thought. Tamer PPI, producer price index, that is. Maybe recession fears or recession risk is rising, but at least the inflation risk is going down. No. Here's the headline for you. Bad news from this week's inflation data. The Fed's favorite gauge likely ticked up. Whoops. What are they talking about? The core PCE price reading likely climbed by 0.3% to 0.4% in February, after rising by 0.28% in January. Most analysts are concluding this morning, because they looked at the CPI and PPI components and realized that, whoops, the PCE, which matters more to the Fed, actually went higher. That will likely boost the 12-month version of this figure, which excludes food and energy costs, to between 2.7 and 2.8%. That would be up from about 2.65% in January, and further from the Fed's 2% target. In other words, if we had recession fear but no inflation problem, yeah, the Fed can cut rates and rescue the economy and rescue the market. But the Fed is handicapped right now. They can't do it because inflation is moving away from their target. Really important to understand. When you look at the annual rate of prices, at least in certain categories, well, the majority of them are going higher. Insurance going higher, drugs are going higher, rents going higher, earnings, housing, restaurant meals, education. So all of that is inflationary. We see certain categories going down like rental cars, appliances, gasoline, furniture, but not enough to say that the inflation process has been eradicated out of the economy. And truth to be said, it's not going to be eradicated out of the economy until you have a recession. The sooner, the better. What is amplifying the inflation fear, though? See, Trump right now increased tariffs. So we're sitting at about 11%. This is the average weighted tariff that we have right now, the tariff rate. And this is the highest in decades, by the way. The last time tariffs were part of the policy and going higher was right before the Great Depression. And there's a lot of analysis and research that has been done before that the trade war and the tariff policy was a major reason behind the stock market crash in 1929 and the Great Depression that followed thereafter. Well, if Trump gets his way, and we have the reciprocal tariffs of 25%. We will have the highest tariff rate in the history of this country. Now, we all know that tariffs are added tax to the consumer. We can argue about, we shouldn't be doing income taxes. We should be relying on tariffs to fund the government. We can debate all of that. But one thing we cannot deny is when you have a tariff and you have a business that has to pay more for the tariff to get their goods, they're going to pass that extra cost to the end consumer. It ain't me saying that. It's all of the companies that came out this week and the week before and the week before, like Target, like Best Buy, like Ross, all of them came out saying that if there is increase in tariffs and we have to pay more, we're going to pass the cost to the consumer. The consumer is well aware of that, and this is why they expect higher inflation, and thus the inflation risk is moving higher. On Friday, we got the one-year University of Michigan inflation expectations, and Michael Kramer says that it seems to correlate fairly nicely with the year-over-year CPI, as you can see in the chart right here. Well, if that is the case, then the CPI is heading higher in time, and that's going to be devastating for the economy because you're going to have the recession fears going on, recession risk going on, unemployment moving higher. But the Fed cannot do anything about it with the rate of inflation going higher. We can have a stagflation problem just like we had in the late 70s. And the headline reads, Trump has never been this underwater, with how Americans view his performance in the economy as tariffs raise stagflation fears. To conclude all of this, to give you the final evidence that the recession risk is increasing along with the inflation risk, and thus we have a stagflation phenomenon. Here's the data that we got from the University of Michigan on Friday. Consumer sentiment plummeting and dropping like a rock. The 5 to 10-year inflation expectations are skyrocketing. This is the highest reading for long-term inflation views since the year 1993, and the drop in consumer sentiment was the worst in 26 years. What you're looking at right now, ladies and gentlemen, is a proof of the stagflation problem that we got in the economy. And now small businesses are beginning to feel it. The backbone of the U.S. economy flashes stagflation warnings as uncertainty spikes on tariff and layoffs. Storm clouds are forming. Well, guess who said all of this, let's say, months if not years ago? Remember when Jamie Dimon was talking about hurricanes and storms and clouds? Like he's in the Weather Channel. Well, now you're seeing it. Jamie Dimon was not lying. As he, by the way, did back in the financial crisis. He warned everybody. Nobody wanted to listen. He ended up being the biggest winner from the crash because he's a bankster, of course. That's what he does. And he's going to win again because he already sold his stock like we've never seen before, cashing in billions and billions of dollars. A recent survey of small businesses raised numerous red flags about the economy, including trends that point toward potential stagflation pressure. That is as President Donald Trump keeps companies guessing on what he will do next on federal layoffs and tariffs, raising uncertainty about prices, costs, and expansion plans. The last thought about all of this. Let's go back to Scott Bessent when he suggested that, sure, cannot guarantee no recession. Sure, the stock market is going down, but this is the price to pay to fix the country. What if that's true? You got Fred Krueger saying that I think Trump wants a crash so that he can get rates to 2%. Guess who suggested that before the media was even talking about it? The guy you're listening to right now. I made a video a few weeks ago and I said, is Trump deliberately creating a recession ? Now, to create a recession, you need a stock market crash. What if that's the case? And the goal is to reduce interest rates. No matter how the pain is, they're succeeding. If that is the scorecard for the White House right now, they're succeeding. They're winning. But he has to convey that to the public. And he hasn't done that yet. Interest rates are going down. Not going to help us a lot in mortgages or using our credit cards anymore. Not going to help at that point because we're already in a lot of pain right now as consumers. What it's going to help, though, is what you're looking at right now. The U.S. government interest expense is now $1.2 trillion. Once again, the interest payment that the government is paying, aka us, the taxpayers, are paying, is now $1.2 trillion annually. And that number is going higher. That is larger than the entire defense budget. Ladies and gentlemen, this is how empires collapse. And if you have this going on and interest rates keep going higher, with the mountain of debt that we got, this country is going to implode sooner than later. When the time comes for your kids and grandkids to inherit the mess, this country is going to look drastically different if this continues. So maybe it is the price to pay to have a stock market crash and a recession to avert this dire scenario from happening. What I don't understand, though, what is the focus on amplifying the stagflation fear? Why don't you just go with the recession fear, recession risk, and cause a crash in the economy and a recession without increasing the inflation risk, without increasing that stagflation problem? And this brings up the conversation about the tariffs. What is the point behind the tariffs and the trade war? Because that's keeping the stagflation problem going. Eliminate that, then we have a recession problem. Sure, equities will go down. Sure, we're going to have a recession, but the Fed is going to cut rates dramatically, and in time, we're going to be out of it. Market is going to recover, economy is going to recover. But if you have that inflation problem sticking, then you got stagflation and you can't do anything about the recession problem. And for what? To bring back manufacturing jobs in this country, which, by the way, we've been losing it. It's been an insignificant part of private employment for years now, for decades, really. You want to go back to the 1930s and 40s and 50s, where manufacturing was a big part of the economy. You want to go back to the 30s, 40s, and 50s with the tariffs. I'm not convinced that that's a good reason to have the trade war, just to bring back manufacturing jobs. It hasn't been a significant part of the economy, and they're going to be replaced by AI and robots anyways. What is the wisdom behind all of this? I think there is none. Now, folks, let's segue a little bit here. We talked about the macro situation, the fears that we have, the risks that we got. The question now becomes, what do I do as an investor? What do I do as a trader in this market, given all of this information? Well, if you following the news, the stock market is now officially in a correction territory. It went down 10% from the top. Now, when the correction happens, 22% of times we see a bear market. 34% of times we see corrections that don't lead to a bear market. I said in the beginning of the year, this is the first video of the year, I said the year 2025, the return of the bear. And now you're seeing it. I think this correction is classic lead to a bear market. And what's leading us to a bear market in technical terms is investors now changing their sentiment. Investors are becoming bearish. Investors are now examining the reality of the economy, the overvaluation in the market, the AI mania coming to an end. And they're saying, you know what? I feel more bearish than I've felt in years, and I'm going to dump my stocks. And as they dump their stocks, the market goes down. As the market goes down, it spills over to the economy, and we have more and more of a recession problem. At the same time, that doesn't mean that we don't have opportunities in investing in such a stagflation situation that we got. You look, for example, at the Japanese yen. That's been going higher, along with the euro, by the way. So when you have U.S. equities and the dollar going down, you see Japanese yen going higher. That's one way you can invest. You got gold. Gold been going higher. It's been doing pretty good, while the equities market been going down. If you look at the consumer staples and healthcare, aka the stagflation portfolio that I gave you a few weeks ago before this whole round began, they have been outperforming the equities market. They've been positive. If you look at bonds, the TLT, for example, that has been positive. So you have a lot of places where you can still be long. But of course, the strategy has to change. Booking profits, shorting more than before, and limiting your longs to these safe assets that are stagflation proof. So the strategy, as I said before, just to recap for everybody, we have two segments in the stock market right now. We have risk off, aka the stagflation portfolio that I gave you a few weeks ago. We talked about that in details. And then we have risk on, which is the stuff that hasn't been working in the last few weeks, but it's been working for the last few years. The cyclical stuff, the financials, the banks, the technology, the industrials, those we consider oil, you consider that as risk on. So how do we deal with this market right now? When it comes to risk off, you want to be long. But when you see rallies and overbought conditions, you want to hedge your positions. And today I made a video for the members of this channel. The title is How to Hedge Your Stocks Properly Using Options. We went in details on how to do that. So folks, if you're watching the program, consider joining us as a member. Links in the description. You can join us on YouTube or Patreon. You don't want to miss out on the conversations we're having. We do a daily show every day for the members. We do bonus videos for the members. Join us so you know what's going on in the economy and markets and how to deal with it. But the second aspect of the strategy when it comes to risk off, buy the dips after rebound rotations to risk on, as long as the narrative stays the same. What do I mean by that? When the risk-off stuff like healthcare and staples become overbought, and the risk-on stuff like technology, banks become oversold, we usually going to have a rotation where folks are going to book profits from risk-off and rotate and buy the dips in risk-on. And this is why you hedge your risk-off positions, you buy put options, you do the strategies that we talked about in that video. As they dip, if the narrative doesn't change, we're talking about the tariffs, we're talking about the trade war, we're talking about recession, we're talking about stagflation, if that stays the same, then the risk-on rebound is just a dead cat bounce. That's not going to last. And the sell-off in the risk-off assets is just transitory. And sooner than later, investors will gravitate back to these kind of assets. So what we want to do is to buy the dip after the rotation rebound is over, assuming that the narrative stays the same. Now, what do we do with the risk-on assets? The strategy remains short and sell these stocks. If you've been long the technology names and the AI mania and all of that, you got to book your profits, get the hell out. If you haven't been participating, you've been waiting to short them, well, you have to be shorting them right now. Then you book your profits on these shorts when we see oversold conditions in these charts, as we see right now. Good point to begin booking your profits on these short bets. Then you want to trade the oversold rebounds. You want to participate by buying call options or buying the underlying stocks of these risk-on assets as they become really oversold and due for a rebound. Then after the rebound is already done, or shall we say begins to mature, because you never know when it's going to be done, as it begins to mature, and I'll give you the signs, as I usually do. If the narrative remains the same, the tariff, the stagflation, the trade war, the recession fear, if that stays the same, then we want to short the rips again in the risk-on assets. So it's the opposite strategy of risk-off, where you want to buy the dips. In risk-on, you want to short the rips. That's a bear market trading strategy. Not just trading, to be honest with you, but investing strategy. Now, before we wrap up the program, folks, I want to do the charts just to give you an update on what to look for this week. In the beginning of the week, I gave my members in Discord the following. These are the conditions, the confirmation layers for the end of the corrective wave. When you see these signs, you should be readying to buy the dip or trade the dip in the risk-on assets, and you should begin to hedge your risk-off assets. Once again, folks, I invite you to join us as a member, Maverick member, here on YouTube or Patreon to access the information that I put out in Discord every day. But I gave you these conditions. Number 1, the VIX below 23. Number 2, crude oil trading above 68. Number 3, the US 10-year yield is above 4.3%. Number 4, the IWM small caps outperforming the other indices. Number 5, the dollar rebounding along with bond yields. Number 6, Bitcoin is trading above the 200 days moving average. Number 7, risk-on stocks outperforming risk-off. Let's check on those one by one and see what we got. When I look at the VIX, the 2 hours chart, is it below 23? Yes, it is. Is it forming a topping in a shoulder pattern that suggests that maybe the VIX will be down to 20 soon? Yes, it is. So we got a check mark on this one. What about number 2, crude oil? Well, it is trading above 68 right now. And if you look at the MACD indicator, we see the confirmation for a shift from a bear wave to a bull wave. And this is the first time it happens this year. So that's a check mark. What about the 10-year yield? A touch above 4.3, but not enough. We'll give it the benefit of the doubt right now because it is forming a higher low. It is showing positive momentum in the MACD indicator. So we'll give it the benefit of the doubt that it's going to stay above 4.3. So we got a check mark here. What about the IWM outperforming other markets? If you look at Friday's session, the IWM in yellow, and then you have the SPY, the S&P in red, and you have in blue, the Qs, the NASDAQ. You can see that the yellow line is the outperformer. The IWM was up more than the SPY and the Qs, so we got a check mark on that. What about the dollar going higher along with bond yields? That's not happening, at least not right now at the time of the program. So we don't have a check mark right here. What about Bitcoin trading above the 200 days moving average? 200 days, the line in orange, we're not trading above. So we don't have a check mark, at least not right now at the time of the recording of this program. We don't have that confirmation yet. What about the last condition, which is risk-on assets outperforming risk-off assets? What you're looking at right now in magenta, I guess, is the VTV, the value index. And in yellow, you have the VUG, the growth/risk-on index. This is the year-to-date performances, approximately. You can see that value is up for the year, while growth is down by about 8% for the year. But let's zoom in a little more to recent sessions. Do we see the VUG in yellow outperforming the VTV value in magenta or pink or whatever the hell that is? The answer is yes. So we got a check mark on this one. So we have 5 conditions that have been met. I don't have to wait for all of them to be met. When I see enough signs, I'm ready to deploy the strategy. Deploy the strategy meaning, once again, hedging your risk-off assets and trading the dips in risk-on assets. So when we talk about risk-off assets, the king of risk-off, the king of stagflation is the XLP, aka consumer staples. We call them consumer defensives for a reason. The XLP is the ETF. Check out what I said about the XLP earlier in the week. Then we're going to come back for an update. Take a look. The yield yield-sensitive risk-off, such as the XLP staples, the king of stagflation. It printed a topping candle right here. We have yet to beat the topping candle. It could be sort of a distribution pattern at the end of the day. We know the momentum is about to shift from bullish to bearish. And now we have to think a little bit. Okay, if we have a shift from bullish to bearish, I told you what the strategy is. On these holdings that you got, the dividend paying, the stagflation theme, you want to sell covered calls and you want to buy some puts as protection. That's called a collar strategy. Or you use the proceeds from covered calls to buy the dips, for example, on the risk-on assets, if you want to be a little more adventurous with the money. But usually the classic strategy is the collar strategy, where we sell covered calls and finance some puts in case there's a flush down. And indeed, the XLP went down all the way to the lower bands and erased huge part of the gains. And this is why it's suggested that you hedge. And if you've done so, you're okay. You're going to use the money from the hedge to buy the dip at some point in the XLP again. And by the way, that goes for not just the XLP, but all of the stagflation portfolio and the risk-off assets that we talked about. I'll give you an example here in the weekly chart of GILD, Gilead, or Gilead, whatever the hell you want to call it. Doesn't matter to me so long as it prints. And it has been printing pretty good. But you look at the weekly chart, we got a bearish engulfing candle. It's a little overbought if you've been a shareholder of Gilead as part of your stagflation portfolio. But it is time to hedge. You should be hedging. You should be selling covered calls and buying some puts, anticipating a correction, as we see a rotation from risk-off assets to risk-on assets. That is, of course, assuming that the White House keeps their mouth shut this week. No more talk about the tariffs. If you talk about it again, we're going to freak out again. But it looks, from a technical perspective at least right now, that we can have a risk-on rotation this week. And among risk-on assets are banks. Check out what we said earlier this week regarding the stocks of JP Morgan and then Goldman Sachs. We'll come back for an update. Take a look. If interest rates are heading down, then it takes away from their advantage, the advantage of interest rate income or interest income, which the growth in interest income in the banks and in the Goldman Sachs of the world, by the way, has been exceeding the non-interest income growth. So they've been reliant on their growth on interest, and now we have lower interest rates, at least recently. And it looks to me that JP Morgan retested the 50 days moving average. It's forming sort of a B leg and an inverse ABC leg pattern. And the next stop is, if we close below the 50 days, is we have a C leg formation. And it could be a steep one, it could be an ugly one. So keep an eye on the 50 on JP Morgan. You lose the 50, you're shorting with both hands. And indeed, JP Morgan was a great short. It went down all the way to the 200 days moving average after losing the 50. 50 in blue, 200 in orange. But it is time to close the short and switch to a rebound bet, because JP Morgan is oversold, as you can see in the RSI. It reclaimed the 200 days moving average as support. It is forming a falling wedge pattern. I think it could go higher and close the gap, around 245-ish. And this is why on Friday's session, I switched to calls on GPM. Another one is Goldman Sachs. Let's hear what I said about it earlier in the week and then come back. And you can see the pattern already playing out here in Goldman Sachs. Bearish engulfing candle, losing the 50, forming perhaps the bear flag. Might be revisiting all the way to the lows right here to close the gap. And the gap would be, the highs of the gap would be 573.50 or 59, The close, which I'd like to go to the close, 571.53. In any case, it's a steep decline. I think all of the financials are still not done going down. There is one big move to the downside of financials, so keep an eye on them. And indeed, Goldman Sachs shed the bed here, lost the 50, and went all the way down to the 200 days moving average, even below the gap that we were anticipating. So it was a great short. But now it's consolidating around the 200 days moving average. It is way oversold. It makes sense to book the profits from the shorts and to rotate toward buying calls, anticipating a rebound. And then we'll see what happens. You can look at other risk-on names. I'll give you some examples, but you guys are big boys and big girls. You can look at your charts and figure it out for yourself. You look at the oversold charts that are beginning to shift from bearish to bullish momentum, oversold charts, higher quality charts, that we could see the risk-on rotation happening in. An example is Amazon. Oversold? Yes, it is. Is it about to shift from bearish wave, as you can see in the MACD, to a bullish one? Sure. So it is worth playing some rebound plays on Amazon. We talked about Delta Airlines in the latest video for the members, that it got really, really oversold. We got the support of about 42.5. It is also worth playing some rebounds in the airliners and the cyclicals that went down big. An example is, if you look at Hyatt, hotels got creamed as the affluent consumer begins to pull back. But is it oversold? Yes, it is. Look at the RSI. We have a falling wedge pattern. I think this chart might begin to recover a little bit, and that's worthy of trading. Now, the big question is going to be from you guys, when you talk about a rebound in risk-on assets, does that include the souffle Tesla? The short answer is yes, it does. When you look at the souffle, it is trying to recover. I'd feel more comfortable if it closes above 253.37 on daily basis. But you look at the MACD wave, it has been bearish for a while now. It is beginning to change to a bullish wave. But you have to understand that the souffle is really, really risky right now. The political backlash against Elon alone and the drop in the number of sales in all of these regions is absolutely stunning. We're talking about 70% drop in sales in Australia, over 80% in certain territories. It's unbelievable, really. And I think that the rebounds in the souffle will be opportunities for the insiders to dump. So it's not something that you want to risk a lot playing a rebound in. So I would suggest if you want to play a rebound in Tesla using call options, use the ticker TSLL, which is a proxy for Tesla, but the options are cheaper than the actual ticker TSLA. The point being here is if you want to bet on a rebound in Tesla, don't overcommit to it. You have easier names that are going to rebound better than Tesla, but if you must participate in a rebound in Tesla, you want to use the ticker TSLL, not TSLA, to reduce a little bit of your exposure to that bet. With that being said, folks, I think this has been a fantastic program. Maybe I'm biased, but I think if you guys are fair viewers, you'll agree that this was a phenomenal program. So let's wrap it up on a good note here and segue to the conclusion of this video. What do we have on the economic calendar this week? Comes Monday, March 17th. We have retail sales. That's going to be more important than ever because of the recession fears that we got. We got the Empire State Manufacturing Survey, business inventories, and we finish up with Home Builders Confidence Index. Comes Tuesday the 18th, we have housing starts, building permits, all important for the housing market. We got the Import Price Index. That's important for the inflation picture, and then we have industrial production and capacity utilization. Comes Wednesday the 19th, an important day because we have the FOMC, the rate decision, and the conference by Chairman Powell. As I said, I expect that the Fed will do nothing, but the commentary by Powell about the tariff risk and the recession risk will be really, really interesting. Then we got Thursday the 20th. We got initial jobless claims and then the Philly Fed Manufacturing Survey, along with existing home sales on top of U.S. leading economic indicators. If it all goes okay and the White House keep their mouths shut, comes Friday the 21st, we got nothing. So that could be a decent rebound day. Now, I would say that you got to be careful, though, with these rebounds if they happen to begin with, because one deadline you got to keep in mind is April 2nd. So we can have a rebound this week and we get back to risk-on assets. You see massive rebounds in Tesla and Amazon and JP Morgan, whatever, and we feel good about it. But if nothing changed in the tariff policy, the reciprocal tariffs, to be exact, the deadline comes April 2nd. Whatever rebound we're going to have will be an opportunity to sell and short, because those reciprocal tariffs, if they go through, they're going to cause a massive market panic. You will see the VIX exploding. You'll see the equities market flushing down big. And if we get a rebound before that, now we've opened the path for bigger declines in the market because we're not oversold anymore. Keep that in mind. But with that, folks, let's just wrap it up right here. I hope that you guys found the presentation informative. And if you did, return the favor by pressing the like button, subscribing to the channel. Better yet, do yourself a favor. Not do me a favor, do yourself a favor. And join us as a Maverick member using the links in the description in YouTube or in Patreon before we jack up the prices higher. But with that, folks, hope everybody had a great weekend, but this is all I got for you for now. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
And you are reborn, but into the same life that you've always been born into. And how many times have we had this conversation, detectives? Well, who knows? And you can't remember your lives. You can't change your lives. And that is the terrible and secret fate of all life. You're trapped